Welcome to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft, and thank you all for joining us today. Now presenting is Chuck Ferry, CEO of DUOT Technologies. It's a publicly traded company. The symbol is DUOT on NASDAQ. And with that, Chuck, take it away.
Thank you very much, and appreciate everybody taking time to view our presentation today. I'm Chuck Ferry. I'm the CEO for DUOT Technologies, as was previously introduced. And I'd like to tell you a little bit about DUOT Technologies. We're primarily a machine vision and artificial intelligence technology company, and we analyze fast-moving objects, and we think we do it better than anybody in the industry. We're headquartered here in Jacksonville, Florida. Small, we've got 75 employees. We currently have 13 portals that are deployed in the field right now, and we have 2 more contracted. So we'll have 15 portals here by early next year. This last year, 2021, we finished at about $8 million of revenue, and I'm pleased to report that for 2022, we'll more than double that and stay in accordance with our publicly traded guidance. Inside the company, we have all of the functions, and we can self-perform all of those functions to design, manufacture, deploy, install, and then operate our portals, and all those skill sets are here in the company, which is very heavily technically based. Next chart. Briefly about the management team. For myself, I have been the CEO now here since about September of 2022. Excuse me, September 2020. And previous to that, I ran a company called APR Energy. That company was in the power industry, much larger than this particular company here. And then prior to that, I also ran a defense contracting company, which serviced primarily IT engineering and professional services for classified customers, and also for U.S. Special Operations Command. And then really most of my career, most of my time in my adult life has been spent in the United States Army. 26 years in infantry, ranger, and special operations units as an enlisted man, sergeant, and officer, with approximately 4 years spent in combat in Somalia, Afghanistan, and Iraq. We have a wonderful team here, both very technically oriented, operationally oriented, and obviously we have our finance folks as well. John Puglisi leads all of our IT and software. John White really is our operating officer, another former military veteran. Both John Puglisi and John White are military veterans. Jeff Nachai is our chief technology officer and has oversight of all of our product and technical teams. Andrew Murphy just recently assumed the role as chief financial officer with Adrian Goldfarb, who's had that role for a long time and has agreed to stay on with us as a strategic advisor full-time for at least the next year. And then Connie Weeks has been with the company for quite a while, and has been a wonderful part of our leadership team. Next chart. Really, we're primarily operating mostly in the rail sector right now. We do have some business that is in the truck inspection or trucking area. And then other areas that we've begun to look at, but really haven't gotten active in yet, is the aviation sector, as well as the edge data center or edge computing industry. Next chart, please. A little bit about our history as we go through this. In 2015, the public company, the company became public by doing a reverse merger to the OTC. In 2020, we uplisted to the NASDAQ. I joined the company in September of 2020. And really what I found here was a company that had tremendous potential, but it really hadn't met that potential. And so we initiated a turnaround. And really for the last 2 years, we're just about done with that now. But we'll talk about that. At the time, we had 11 portals deployed, and we did finish that year, even though that was the first year of COVID, at about $8 million in revenue. 2021, we really started to improve the technical and operational delivery of our teams. That was intended to regain customer confidence with current customers, which includes CN, CSX, as well as KCS. We were successful in winning a very large Amtrak contract We developed and deployed our oblique vehicle undercarriage examiner, which we'll show you here in a little bit. We did some capital raise, but we did finish again kind of flat at about that $8 million of revenue, which we did adjust about midway through the year, but we did end up and we did meet that guidance of that $8 million. This year has been really coming out of that turnaround and starting to come out of all the COVID hangover type stuff. We've effectively imaged now millions and millions of rail cars. We've developed and have now deployed now more than 28 artificial intelligence use cases with high reliability. All of our existing customers have renewed their contracts and expanded them in many cases. And we're on track to finish with 13 portals this year. And we are on track to hit our public guidance, which is listed there. So really what's next? And I think that's what's the most interesting is that we'll continue to add to our artificial intelligence use case portfolio. You can go online now, I think, and see that portfolio or ask to take a look at it. We plan to expand our existing contracts. We expect to continue a 100% renewal rate. But very exciting right now is we're going to expand to a subscription model. And let me kind of frame it like this. Basically, with all these millions of rail cars that we're imaging, we've now determined that many of the car owners, car lessors, and car operators, which are not owned by Class 1s, are very, very interested in subscribing to the data. And so we'll talk a bit about that here in the next few charts. Our objective for next year, not public guidance, but our objective for next year is to earn between about $20 to $24 million of revenue, get close to a break even by the end of next year. And that, again, will be a very nice pickup in overall revenue and overall financial objectives. On a go-forward basis, it's our intent to expand the number of portals that are deployed, expand our artificial intelligence, and most importantly, expand the subscriptions and diversify, particularly with what we're doing in the rail sector. Next chart, please. These good pictures of two of our railcar inspection portals. The one on the left with CSX is, we call it a generation 1, but really it's our base portal. It can see 20 to 25 individual inspection points on each railcar, top, sides, and bottoms. We have 3 railcar inspection portals that are deployed with Canadian National. Those portals are a bit more sophisticated and see up to 92 individual inspection points. Next chart, please. Here's some real nice images or example images. Obviously, the top left, you can see our CSX trains. And what you're seeing is a side view, and this is actually done with line scan cameras that are then stitched together through a set of software to make it appear to be one single rail car going at very high speed, typically 50 to 70 miles an hour. On the bottom left, you can see a top view. This shows a knuckle pin and coupler, and you can see the level of detail in that photograph. The bottom middle area of interest, you can see the side trucks. This is our side view, again, that focuses on the kind of the bottom third of the rail car. And then the top right corner is from our oblique vehicle undercarriage examiner. And that can actually see upwards of about 25 individual inspection points. This is down inside the track, and it looks up at an oblique angle. It can see all the nooks and crannies up inside the rail car there, to include the F-pin, which is a very difficult item to see, particularly while the car is moving. And then you can see the last one there again is from the bottom, and is showing this is from our regular vehicle undercarriage examiner. Next chart, please. This is the proprietary software and AI user interface. We call it Centrico. This is all done in-house by our software development team. But this is how the customer interacts with the train. Basically, you can see all the different views. All the cars are correlated to each other. They're tagged. You can see the AEI tag reader. It shows the specific owner and the number on the car. That is then displayed over on the right-hand side, where you can see all the cars listed in what they call a train consist. And then if an artificial intelligence algorithm fires, you'll see it listed in red. and that'll flag the carman to take a harder look at that particular car. Next chart, please. Here are some examples of our Railcar AI detections. You can see, again, very high resolution photographs. For example, a tank car missing cap. The next one is a brake piston engaged. Again, the knuckle pins, which we saw earlier. One of the big ones that we've been doing for Kansas City Southern, as well as for Ferromax, is illegal riders, which you can imagine is very important as trains are crossing across the border on the U.S.-Mexican border. And then obviously open hopper gates, axle rubbing is another big one. And again, we've got 28 of these now, and we will probably double that number here by the next year. A little bit about the rail car industry. Interestingly enough, most of the rail cars that are out on the track are largely owned not by the Class 1 railroads. So on the left side, you can see that the ownership by Class 1 railroads has actually decreased from like 25% down to 16% of the overall fleet of approximately 1.63 million rail cars. But you can see TTX, which is owned by the collection of Class 1s, but they're basically a leasing pool, if you will, for them. That ownership is increased. Then you can see where shippers and then also car lessors have, particularly the car lessors, has actually gone up. Of the approximately 1.63 million rail cars on the North American network, that's an estimated anywhere from 300 to 400,000 of them are in storage at any given time. Next chart, please. So with the rail industry, I'm often asked, well, Chuck, why isn't your company growing faster? Why isn't the adoption of your technology going faster? There are some headwinds, which when I first arrived 2 years ago, I don't think that I or the company fully realized what some of those headwinds are. We do now, and I want to share those with you. First, we've always talked since I've been here that the total addressable market, if we cover the entire Class 1 network, it's around 150 RIPs, and we haven't changed that. But we have seen some headwinds in that the Class 1 railroads are generally, while they like the technology and they'll publicly praise it, they're internally a bit slow to adopt it full scale. Part of it is it is a big capital investment for them, and it competes with other technology and other initiatives that they're working on. But also too, there's resistance from the labor unions, and then the regulations themselves actually still require a physical inspection on outbound trains. But we are starting to see some what they call waivers on those regulations being put in place, and we're supporting several of those waivers with our current customers. So what we've determined here is we've got to find alternative and other pathways to get our technology out there, and we're going to do that through the subscription model, which we'll talk to here momentarily. We are still challenged by the supply chain as well as inflation. The time to put in a portal, 2 years ago, from order to actually installation, it could have taken about 3 months. We're now finding it's at least 6 to 9 months. In particular, servers, computer servers, and cameras are particularly difficult items to get a hold of, and are what we consider long lead items. Next chart, please. So what we're going to do here is we're going to transition to a subscription business model, and what this really means is that let's say over the last 90 days we've imaged approximately 1.5 to 2 million rail cars. Of those rail cars, only 10% of them or so are actually owned by a Class 1, which is currently who we've sold into. And then even fewer of those cars are actually owned by the Class 1, where we've actually sold the Railcar inspection portal. However, we're seeing hundreds and hundreds of railcar owners and lessors in our data. And so over the last 3 or 4 months, we're now in discussions with a number of those large car owners, and they are very interested in basically purchasing a subscription which will give them access to their rail cars through an extension of our license and support into them. So basically, the total addressable market now goes from 7 Class 1 railroads and now goes to several hundred car owners. Many of them are very, very large billion-dollar organizations. All of it will be in a recurring format, which makes our backlog and makes, I think, the value of the company much greater. The gross margins that we can achieve are improved. And in particular, we can make more money off less portals than we can under the current format. We can still sell and will sell CapEx portals and continue to support our current customers, but on a go-forward basis, we'll be more focused on these subscription portals. Next chart, please. You can see this is our consolidated income statement. I won't go too much into it. You can read it yourself. Bottom line is last year we came in at 8.2 million. We are on track to hit our guidance for FY 2022, which is a pretty big pickup for us. And some of the other financial metrics, we'll see improvements in our margins, as well as an improvement. We'll still lose at the net income level, but that loss it will be less than it has been in past years, and we'll be moving towards a break even as we get to the very, very end of 2023 is what we're working for. You can see our balance sheet here. Of particular note, compared to last year, our cash position is much better than it was right now, where it was last year at this time, significantly better, in fact. And that has allowed us to actually begin to order long lead items for our portals that we plan to build this next year. Next chart. And then finally, our capital structure. Everybody can take a look at that, but of note, we did do a small private raise that was put out in our filings, and this is now the current cap structure. We've made it a distinct effort to make sure it's as clean as possible. I believe that the warrants that are currently out there have now expired. And so that you shouldn't see most of those that are in there anymore. Next chart. And to wrap up, first off, we think we're making good progress. We'll have doubled our revenue. We're expanding our potential customer base significantly now with the subscription model. That will definitely help improve our financial position. We do have good, now I talked about the headwinds, but we do have some strong good things that are happening in the rail industry. So the Federal Rail Administration and Transport Canada have become much more supportive over the last year or two of our technology. And we are seeing now much more active interest from not only Class 1s, but also our passenger rail, transit rail. We're also getting quite a few international inquiries right now. Our technology that's deployed out in the field is much more reliable and stable than it was here 2 years ago, and that's why customers are keep renewing. And this artificial intelligence is really taking on a life of its own, and that is the ultimate goal for us to be. That is the conclusion of our briefing, and we'll take any questions or comments, please.
All right, Chuck, thank you so much for your presentation here today. And yeah, I have a few questions for you. We'll dig right in. So I wanted to, we've done many interviews over the years, and I don't think we've ever talked about the competitive landscape. Who are you competing against with some of these tier 1 customers?
Yeah, well, there's really 2 groups. The first group, competitors for us, for example, probably the closest one is Benavision. Benavision has a portfolio of products. They are owned, recently were acquired by Wabtec. So they're certainly one of our competitors. Not completely direct competitors, but adjacent to us, but close enough. WID, as well as KOD Labs, as well as Camlin, and a couple others. But the second category, and one that we have to watch closely, is the Class 1 railroads themselves. So some of the large Class 1s, they have significant resources, and they have shown interest in developing their own technology, and in some cases now developing their own artificial intelligence. So that's something that we always have to watch out for, and not take for granted.
Well, going down that rabbit hole, I mean, what are some of the things that the company is doing in order to, limit some of that potential risk?
Yeah, so one of the things, and you'll see it in our filing, so we do have a strong portfolio of patents that we actively manage and maintain. And we have quite a bit of a trademarked and copyrighted material. All of our software, of course, is very closely held, as well as the artificial intelligence. So that's one protection. But the other thing that I think really what we're trying to do is, one, work closely with our current customers, as well as the Federal Rail Administration, to really kind of stay at the cutting edge. We've been told by customers and regulators that our technology, as it stands right this moment, is cutting edge and probably more advanced than anything else that's out there. And that's just something that we want to stay in that position as long as we can.
Absolutely. So another question was on, you mentioned quite a bit throughout the interview or throughout your presentation, as well as on this final slide here, about the transition to more of a subscription-based model. Can you tell us, so, I mean, was this driven mostly from some of the customers you were looking to acquire? Because it seems like, potential for hundreds of additional customers through this, so was that where this was mostly driven from, or also was it from the existing customer base also looking for something like that?
Yeah, I think, well, it was a combination of things. One, as I talked, we turned the company around in the last 2 years. One of the big components of that turnaround was we made some significant improvements, both with people as well as processes and tool sets inside our software and our artificial intelligence team. And it, probably about 6-8 months ago, that team, which is way better, was able to analyze our data. And when you looked at the data that we had, it was almost eye-popping to see, who actually owned the cars that were going through, and we could analyze that and break it down pretty far. So that's kind of where we immediately recognized that we could be selling our data into these other customers. We then validated through many of those potential customers a significant interest in that. So that's that along with some good advice from Mr. Ed Harris, who was on our board of directors, is now back as a chief operating officer with Canadian National. He was pretty adamant that the car owners would really be keen on having access to that data.
Very good. All right. So here's a question that I'm asking every company that's presenting here today. We're in tough markets right now. What would you say are some of the things that the company measures that the company is doing in order to mitigate some of those macroeconomic pressures that are affecting most microcaps right now?
Yeah, obviously the market, it's very tough right now, and it is certainly companies like us that want to raise money. It's tough. We were able to successfully do our raise under those conditions, and I think we were able to keep it nice and clean as well. And I think largely that's because of our story, and quite honestly, also because of the support from some of our long-term shareholders. Secondarily, the supply chain is probably one of the biggest risks for us right now. What we've done in particular is we brought back most of our procurement and almost all of our manufacturing back to the United States, and in most cases back here in North Florida. And then we've also gone and where we're doing self-performing a lot more of our work, to include our manufacturing and all of our installation and as well as our service and maintenance. And then we've also made investment. So from a cash position, we're in a much better condition right now. And we've used that to be able to procure ahead of time or ahead of orders, particularly with servers and cameras. So that when we do get orders, we can shorten that time from interest to actually to installation and make that shorter. So those are some of the things that we've been doing, just along with normal controlling costs and just being careful.
Absolutely. All right. So final question for you here today, looking ahead at 2023, from what you can tell us, what would you say are some of the company's value catalysts that you want folks to pay attention to here?
Yeah, the biggest one is going to be this subscription model. And so what we're intending to be able to show everyone is that we've already inked our first subscription customer. I need to keep it confidential right this moment, but we do already have one subscriber, and we have several more that we intend to be able to prove, to the markets that we're able to get this subscription interest, and that will also be installing 5 of our own portals where we're going to own and operate those portals at key locations here around the United States. So I think that's the big headline for us next year.
All right. Well, Chuck, thank you so much for your presentation here today, as well as answering my questions. To everyone watching, listening in, thank you as well. Enjoy the rest of your conference. Chuck, thank you.
Thank you. Have a good one.